Rates and uncertainty might cause different products to do better in this mortgage environment. Let's talk about it on Today in Mortgages. Hey, what's up, Dreammakers? Welcome back to the show. We're talking about what's real, what's hype, and what you should actually be paying attention to out there in the world of mortgage and real estate news. It's Today in Mortgage. And obviously, in the past couple of weeks, we've been talking about tariffs. We talk about rates for the last 5-10 billion years on this podcast. But today, we're talking about the confluence of two of those things and what it's kind of doing for some of the products that may not have been as popular, but might be seeing a little bit of a resurgence. The article we got today is from CNBC.com. It says, Homebuyers rush to riskier loans as tariff turmoil pushes interest rates higher. So, Rich, what are some of the things that are kind of coming back into vogue right now that maybe hadn't been something that we've been looking at recently?
Well, mainly adjustable rate mortgages, Michael.
Okay, so Rich, let's talk about that. Why is that becoming kind of a more attractive product right now?
Well, it's because the interest rate is slightly lower for a shorter fixed term as opposed to a 30-year fixed rate. So it's a little bit lower, but it's not that much lower.
And Rich, is the thinking here that I'm going to get into an ARM and then possibly refinance out of that when rates drop because I don't have to worry about it adjusting up? Or what's the kind of logic behind this?
Yeah, it just has a lower start rate. So, for example, on a $800,000, you're generally not going to use them on shorter or smaller loan amounts, $500,000 or below. They're mostly being used on larger loan amounts where an $800,000 loan at 7.5%, if you get that same loan at 7%, it's about a $265 difference. So that may make a difference. I mean, considering your mortgage payment is going to be $5,600, at an $800,000 loan. So that, $260 isn't a big deal considering the payment itself. But people are rushing just because that's what's out there. But there are better options. There are better options to bring the start rates way down. So one, Michael, you can do a permanent buy down using seller concessions. So instead of negotiating to the seller pay some repair, some small repair, maybe you negotiate for a 1% buy down, either permanent buy down or a temporary buy down. Maybe you can do a 3-2-1 buy down where it starts, 2 or 3% less in the first couple years and then steps up. There's just better ways to do it, but people are considering it because they're like, oh, well, everybody's telling me I'm going to be refinancing in 18 months anyway. Why don't I just get this 5-year ARM refinance somewhere in between there? Well, we don't know what's going to happen. I mean, considering all the changes just in the last 30 days, we thought we were on a year of Fed rate drops, but now we may not see a couple of rate drops till the end of the year.
Rich, as always, it's a very complicated, nuanced issue when you're talking about what rate, what product is right for my loan. And so I think that's the important part of being just uber pro in this area and knowing the product so that we can talk consumers through that. Rich, how are we training people here at Network to talk about these things?
We just ask more questions than most. That's it. The guys are trained to ask more questions. Why an ARM? Because we know there's not a giant benefit. The rate spread, the difference in the two rates of a 30-year fixed and an ARM is not that wide. It's narrow. So ask a couple extra questions. Are you sure you're only going to stay in this house for 3 years? What if you keep it? Then what? There are additional questions you can ask. You can, use seller concessions. Talk to them on how to use them. Most people think it's just to go to pay closing costs, but you can actually use it to buy the interest rate down. So there are a lot of things you can do that the buyer may not know about. But if you're working with a pro, especially one with network funding, they're going to step you through your options as opposed to just committing to an adjustable rate loan.
Yeah, because I think what the deal is that obviously maybe that ARM helps them get the rate down now. There's kind of that initial win there, but we're always trying to go for that long-term relationship to get the next loan and the next loan and the family referral. And so making sure that we're putting them in a product they're going to be happy with long-term gives us the ability to continue that relationship and just build that business. And I think, Rich, that's what you're all about here at Network Funding. You're all about coaching people into looking at that long game, which I really appreciate.
Well, Michael, just on our last podcast on Tuesday, we talked about what Fannie's projections for interest rates to be. Keep in mind, 6.3 by the end of 2025 and 6.2 in 2026. The rates are not going to drop that much. So don't get into an ARM when you can permanently buy down a fixed. That's what I'm trying to say is don't commit yourself to a riskier loan when you don't have to. There are lots of options for you, but the most important thing is to talk to a pro. Talk to a mortgage pro, someone that's been in the business a while that knows how to discuss these different loan programs with you. That's the key.
You should definitely be working with a pro. We love working with pros here at Network Funding. We're always looking to grow. If you're a pro out there looking for a new home, check out the Grow link below. Get in touch with us, and Rich himself will talk through how to be a part of the best network in mortgages with you. Rich, before we sign off today, any final thoughts you have on what's going on right now with ARMs, with other products, anything in the market you want to talk about?
Well, I mean, I just heard Chairman Powell talking about how they need to sit back and evaluate what these tariffs are going to do to prices. And, the mandate of the Fed is for maximum employment and stable prices, a solid economy. And the tariffs threw in a different, mix of concerns that may actually push out the Fed rate reductions so that they can evaluate what's happening. What they don't want to do is drop the Fed fund rate, lowering interest rates, spurring buying and causing inflation to rise again. That's the whole, kind of balancing act that's happening. And an unknown was thrown into the pit. And now, there's some more wait and see moments. So that's why we saw the market lose 700 points today. It's just kind of crazy. So don't focus on the noise. Talk to a pro, find out what mortgage you qualify, at what rate you qualify for, buy the home today.
Good word, Rich. Talk to a pro, be a pro. You guys out there are pros for watching and listening here. We appreciate you wherever you are. And we're going to sign off on that. And thank you so much for watching, listening, wherever you are. We appreciate you. See you next time on Today in Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates. And any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.